Okay, great. Well, why don't we get going here? And hello and welcome, everyone. I want to thank so many folks for joining us today. We have hundreds on the line now, and I know more are still coming on. On behalf of all of my colleagues, we hope you're well and safe and starting the new year off in good fashion. This is actually our largest attendance ever for this annual update, so that's exciting. And we're just thrilled to have so many clients and friends of the firm joining us. I'm Bob DiMeo, very, very pleased to be joined by Matt Rice, our Chief Investment Officer, as well as Brad Long, our Deputy Chief Investment Officer. And if we talk about today's agenda, for folks who have attended this in the past, we're really planning on covering three things here, and we plan on doing it all in under 30 minutes. So first is a super brief update on Fiducient Advisors. Next, we're going to update you on the capital market forecast. So what are we looking for from stocks, bonds, and so on over the next 10 years? And then finally, you'll definitely want to be a part of this. We were going to go ahead and give you some market outlook, navigating the moderation in returns and such, and also the volatility, and really trying to give you some practical pointers to any sort of investor. We'll ask you to use the chat box if you'd like to ask any questions. And so why don't we just dive in here with a quick update with respect to Fiducient Advisors. If you take a quick look on the upper left-hand side, clients served four main verticals: retirement plans, endowments, foundations, families and individuals, as well as financial institutions. And we feel very blessed that we experienced growth in all four categories, and the outlook is very bright. If we take a look at some of the milestones for 2021, we did have a rebrand. We shifted from DiMeo Schneider to Fiducient Advisors on April 1st, and that's been exciting. I think pretty much everyone's thrilled with that, except for my mom, but she's happy about it too. We also crossed a really meaningful milestone in the fourth quarter. We're now up over $250 billion under advisement. And frankly, leadership at the firm is just so proud of our colleagues, and it says a lot about the confidence that our clients and friends of the firm have placed in us. We also, late last year, the P&I rankings came out, ranked number 21 in terms of top global consulting firms by way of size. And then we graduated approximately 50 more individuals from our internship program last summer. That makes the 2 summers that we had the program, we've had about 150 graduates, about 3/4 of them from underserved or underrepresented communities. So again, tip of the cap to my colleagues for really doing a lot of great in that respect. Want to go ahead and very briefly touch on 2022. We have a handful of new partners as well as 5 new principals at the firm. So congratulations to them. Many others who have received promotions, and many others who just day after day get after it and do all they can on behalf of clients and colleagues. So thank you to all of them. We are continuing our DEI focus and efforts, both internally and externally. We have an engagement letter and all sorts of information on our website. There is always more to do, but we're proud of our work to date. We are planning, fingers crossed, on in-person conferences this year, bringing those back. So we are expecting in the spring a conference in Rhode Island, and in the fall a conference in Chicago, and probably others, environment permitting. So we'll keep you posted on that. And finally, check out the careers page of our website. We're doing a lot of hiring, and we're also investing a lot in training as well as technology and so on across the firm. And on the lower right-hand side, I just want to remind folks that we are profoundly committed to doing all we can to help our clients prosper. We know that means something different for every type and frankly, every client. So it's our job to really do all we can to understand objectives and goals, and then craft a strategy that gives clients a fighting chance of achieving those goals. So with that, I'd like to jump right into it, introduce Matt Rice, who's going to take us through our 10-year forecasts.
Thanks, Bob. Good morning. I got the mute button wrong right out of the gate, so I haven't figured it out yet. But thanks for the intro. It's great to see everyone. If we take a look really at the first slide in our deck here, as we go into and really look at our capital market assumptions, there's going to be a theme as a part of this, and that's really valuations look quite elevated across the board. And so when we say that, I think a lot of people think we mean, okay, it's time to get out of stocks, or it's time to make drastic moves. And I think this is a good illustration of why you don't want to do that. When we take a look at the left slide, or the exhibit on the left side, we're looking at valuations from a price to earnings ratio, and then we're looking at really the subsequent 1-year return. So while you see that higher valuations generally means lower returns, if you look down at the bottom there, you see R squared equal 3%. Really what that means is just because you go into a year with a certain valuation really only explains about 3% of the return in the coming year. However, when you look out at the right side of the graph here, this is the same graph, except we're looking at really 5-year returns. You can see the same dynamic where it explains lower returns, but the explanation, or R squared, is 39%, which means valuations tend to matter more meaningfully over the long term. They don't really matter that much year to year. So when you hear us talking about elevated valuations in certain asset classes, you shouldn't take that to mean that we're suggesting to be tactical or to move out of stocks or something along those lines. So with that, let's dive right into the capital market assumptions, really starting with the equity return forecasts. We start off here at the very beginning, at the very top of the page, 7.2% on the global equity return side for the next 10 years. That's actually a 0.4% increase from a year ago. When we look really underneath the hood at various segments, large caps U.S. equities at 5.7%, which is an increased return of about 0.4%. Just a couple of important notes to make on that U.S. equity return. That's actually the second lowest nominal return forecast we've ever had since we started doing this process in 2003. But it's actually the lowest real return forecast that we've had. And what do I mean by that? I mean, when we look at really where we were a year ago, we had a lower return expectation a year ago. Returns were really strong in the last year, but earnings more than kept pace with prices, and so that really is what's leading to the increase in nominal return. But at the same point, we saw an increase in inflation, our expected inflation rate, from about 1.8% to 2.5%, which is really about a 0.7% reduction in the 0.7% increase in inflation, which is a 0.7% really reduction in real returns going forward. And so while our large cap equity return forecast is higher on a nominal basis than it was a year ago, it's lower on a real after inflation forecast. When we get into the international emerging markets, we can see we really think there's more opportunity outside the U.S. than within the U.S., at least over the next 10 years. When we look at things, valuations are much more compelling there. We've really seen U.S. equities dominate in most recent years, which has kind of led to really increased valuations. And when we look at really market cycles, full market cycles over 10-year periods, generally no region stays at the top forever, and we're expecting really some outperformance within the international and emerging market space. We continue to work through the deck here to the next slide, really the fixed income. Cash is essentially still sitting at zero, so it's a pretty expensive place to be with inflation over the next decade of 2.5%, at least from our forecast perspective. Really running closer to 7% over the last year, but expecting to moderate to 2.5% over the next decade. Treasury inflation protected securities, while on one hand they're great inflation protectors, they have really challenging from a really low real return expectation, so only a 1.3% return. So we look at munis and U.S. bonds in that space. The Bloomberg aggregate bond index, which is our U.S. bond forecast of 1.7%, which again is about 80 basis points below our inflation expectation. So we talked about stocks looking elevated from a valuation perspective. We're expecting really negative real returns within the fixed income markets. We look at the high yield, the muni high yield, and the corporate return segments a little bit higher there than obviously within the investment grade, but at the same point, credit spreads remain relatively tight. And then we look at the very bottom here, dynamic bonds and global bonds. Dynamic bonds are really an amalgam of multiple asset classes and really more of a strategy than an asset class. We expect a 2% return there, and within that asset class. Global bonds, we actually saw a pretty meaningful increase in return of about 0.6%. So while interest rates rose in the U.S., they also rose overseas. We take a look here at the real asset segment. Real estate really put up a very strong return last year. But despite that, we're still expecting a higher return forecast over the next 10 years. Real assets really across the board performed very well as inflation returned to the market. We look out over the next 10 years, we expect real assets to continue to be a valuable diversifier within portfolios. We look out really over for marketable alternatives, hedge funds, 5.9% return forecast, and private equity of 8.9. So we really look out over the next decade. We always tell our clients to really take the long-term view if they can. But we do think over the next 5 to 10 years that we're in for a fairly modest return expectation environment compared to the recent past.
Hey, Matt, that's super helpful. Thanks for that broad overview. As you were talking about equity returns and a little bit about U.S. versus foreign, what's the firm's view on the need for foreign, or how does that unfold on a go-forward basis?
Yeah, Bob, that's a great question. We think international equities remain a really important diversifier within portfolios. These things are cyclical. We've gone through, I think a lot of people forget this, but the last time we were in a valuation environment like this was the late 1990s. And we're not quite, from a U.S. equity market perspective, not quite at the 1999 valuation levels yet. When we looked out over the next 10 years, U.S. equity returns were actually negative during the next 10 years, coming out of that 1999 environment where emerging markets, for example, put up double-digit returns in the following decade. So it's really important to maintain diversification, despite the fact that it really looks like, wow, it feels like over the last few years that all we should have been doing is investing in the U.S. It's important to stay diversified.
Thanks, Matt. That's super helpful. And I think a great segue actually into Brad Long's part, where he's going to talk about 4 themes and really practical ways that investors can be looking about this environment and what they should be potentially doing with their portfolios.
Yeah, thanks, Bob. So many might have seen, we sent out our kind of written version of our annual outlook. We're going to take some of those information and put it here in a couple slides, but should you always have more questions or information, just please feel free to reach out. We're happy to go into any of these. So, as we segue from long-term outlook into kind of what do I do in my portfolio today, there's a couple of things that really come to light as we think about the playbook for 2022. We would put them into 4 categories. First is kind of the mental shift from pandemic to endemic. We've gone from 39,000 vaccinated at the beginning of 2021 to over 4 billion vaccinated, yet the 5-letter acronym of COVID remains in our daily life. So what do we do as an investor with that? The second bucket here is policymaker tightrope that they're going to have to walk. That's obviously the Fed, but it's also global central banks. And what does that mean for my portfolio, both across asset classes and the potential volatility associated with it? Bottom left here, the conversation or the narrative really has been, is inflation or coming or going? We would answer that question with a yes, but we'll give you a little bit more context as to why. And then finally, volatility ahead for some of the reasons we just mentioned, and also a couple of others. So, as we jump into it and kind of start with that idea of pandemic to endemic. Well, as we look at the volatility that we've seen and drawdowns we've seen in 2020 and 2021, the parts below the blue line here are those drawdowns over those 2-year period. And there's probably no coincidence that, those periods pretty neatly align with new variations of COVID and kind of the headline risk of that. And we would say 2 things jump off the page to us about that. One is that COVID-0 is unlikely. This is likely a risk that's going to persist. The headline risk will persist and the real risk will persist. But we should be prepared for that and think of it as a secular issue, not a transitory one. The second is that the severity of these drawdowns has been decreasing over time. And that's where the market is really moving with this notion of pandemic to endemic, is it's going from an unknown risk to a known unknown risk. We know that COVID variants are going to come, but we don't know the severity, we don't know the timing, we don't know the magnitude. So as we have this mental shift, we think that investors should really think about this as kind of a secular part of investing and how they build it into their portfolio. But other impacts from COVID really, lie kind of across the investing landscape. And one of which we use to exemplify this is the difference between value and growth investing in the 2 years preceding COVID and the 2 years post, so 2020 and 2021. Now, the graph here is the absolute difference in return between large cap US value and large cap US growth. But this is an example of some of the extended differences that COVID has had on market prices. So if we look at the 2 years preceding, kind of 2018 and 2019, the weekly difference between large cap US growth and large cap US value was about 0.75%. So there's obviously some differences in price volatility there. But if we scan forward towards, the 2 years, including COVID, 2020 and 2021, obviously the difference has exaggerated there. And that has a couple of practical inferences to us, but this isn't just a value growth conversation. We've seen similar increases in volatility amongst sectors, amongst factors, amongst country allocations or regions. And so what do we do with this information? And if I'm sitting in your chair, how do I practically take, okay, pandemic to endemic, good tagline, but what do I do? There's a couple of things that we would note. So first is we've enjoyed great returns in markets through 2020 and 2021. So take advantage of, maybe some of these highs and reassess the volatility that's in your portfolio. Maybe your corpus has grown to a point where you don't need to take on the same level of volatility. Great, take advantage of that. Or at the very least, assess the volatility you have today so you're prepared for potential future volatility. The second is diversification. With greater volatility amongst sectors and styles and factors, that actually adds to the benefit of diversification in your portfolio and increases the benefit of a smooth ride. But the difference in magnitude and the importance of timing there also tells us that the cost of not diversifying and trying to time markets is also higher. So we'd be wary of that as well. And then finally is kind of ready your rebalancing playbook. If you're not currently working with Fiducient, we have kind of a framework around this, but we just think it's unlikely that rebalancing is going to neatly occur at the end of a quarter, at the end of a calendar year. So we do think that you should be prepared for that coming into the calendar year. So as we move into kind of the tightrope that the Fed is going to have to walk, look, if we go and we look over recent history, the dark blue line here is the ascension of the S&P 500. The light blue line is what our version of a proxy of how accommodative the Fed has been. If you're an econ nerd, this is M2, we would call it money supply. This stair-step function here in the middle is really when the Fed came out and said, look, we're about to manufacture a recession, we'll do whatever is needed. And they really stepped up. Well, that accommodative stance has persisted, and you can see equity markets have really enjoyed the benefit of an accommodative Fed policy, and those markets have really moved in lockstep. Now, as we move into this phase, which at the very least is taking our foot off the accelerator, I would argue, and we'll argue more, and we'll give you more context around that, the Fed is entering a new phase, and we'll talk about that more in just a moment. But this obviously isn't just a equity phenomenon. We're also talking about this across fixed income. And so the two graphics here, the dark blue is the duration or the interest rate sensitivity of the Bloomberg AG. And then the light blue line is the compensation or yield to maturity associated with that index. And you've seen, since that the Fed took that great step into the market and trying to, push us through the manufactured recession, duration has increased across these indices, but the compensation associated with owning those indices has not commiserately risen. So what does that mean for us as investors, and what is that potential risk as the Fed, the futures market currently has 4 potential interest rate hikes priced into the market in 2022. Well, there's a couple of things practically we would look to. Now, the first one is something that we've always talked about, but we think is probably worth revisiting, is just this is a healthy environment for active fixed income. Following a rules-based systematic approach is likely to miss some of these bigger, longer-term trends. And so we think actively managing those risks is very prudent. To the point of managing risk, interest rate risk and potential volatility associated with interest rate risk is rising. So at the very least, know the interest rate risk that's poised in your portfolio. At the most, think about strategies that you can either take advantage of greater interest rate volatility or manage that volatility relative to your expectations. We'll get into this one a little bit more in a moment, but to set that stage, as the Fed is entering into this new cycle of potentially rate hikes, lowering accommodation, we do think the equity market is going to be more focused on the need for growing earnings, not necessarily paying more for earnings. And so that has an inference on potential volatility. And then finally, most of the conversation we're having around the Fed or many other central banks like the Bank of England or others, that is around reducing accommodation or potentially tightening. China's actually been singing the opposite song. The People's Bank of China recently has become more accommodative. They had a tough equity market last year. They have a economy that's not growing as quickly, and so that might provide opportunity in emerging markets. So it's going to be a pretty interesting environment from which to navigate policy going forward. Now, inflation, one of the new favorite investing words in the lexicon, I would say the first thing about inflation is any forecasting should come with a heavy dose of humility. Our brains are somewhat linear functioning things. Inflation lives in a dynamic world that is exponentially complex and lots of change. And so timing inflation is very difficult. But because we've tried to simplify the fairly complex nature of inflation, I think we've oversimplified the narrative and said, is it coming or is it going? Is it transitory or is it persistent? And our answer to that earlier was yes, and we'll give you some color as to why. So transitory, there are a number of factors where we think 2020 and 2021 were fairly unique. Let's give you some examples. In 2020, WTI, US oil prices, actually printed negative. Someone would say, I will pay you to take my barrel of oil. Now oil is sitting around $80. It's unlikely we're going to replicate that exact same environment in 2022 or beyond. Let's also look at autos. That's a good example. In the second half of 2021, used cars were up 25 to 30%. Most people don't think of used cars as an appreciating asset. So the persistence of some of these factors we think is limited and then will start to wane. But nonetheless, there are other factors that can be and will likely be more persistent when it comes to inflation. So if we think about wages, we have a record number of resignations along with a record number of low layoffs. That shows that there's more buying power behind employees, not employers, and wages are likely rising, and wages are sticky. So they end up in inflation, one, because businesses pass on the cost of inflation to consumers, and two, consumers have more money in their pocket and are willing to pay more for goods. So that pushes inflation higher. The second is when we look at rents and housing prices. Now, CPI has a little bit of a funky mechanism to judge rent. They actually look at it as owner's equivalent, where they send a survey to homeowners and say, what would you be willing to rent your home for? Well, as the price of housing has risen, so has their survey responses and what they're willing to rent their home for. And that's a lagged factor, which we could see continue to push inflation higher. So actually tomorrow, July 12th, depending on when you're seeing, or sorry, January 12th, we should see a CPI print. That could actually have a 7 handle on it, meaning 7% or more. That shouldn't surprise us in the short term, but we do think that that moderates over time. So practically, what do we do about this as investors? We do think that this is one area where, especially in this period of shift, we should be broadening our diversification across real assets and not making singular kind of, I'll just own commodities or I'll just own gold. We do think that there's benefit of broad real assets. And if you don't have real assets in your portfolio today, potentially considering introducing those. The final phase here from a volatility perspective. So we talked about, shifting from pandemic to endemic. We've talked about policy and becoming less accommodative. And we've talked about the shifting sands when it comes to inflation. Well, the final factor here is when we mentioned, the willingness for investors to pay more for earnings. Well, equity earnings have really gone through 2 phases here. The first has been, again, we mentioned the willingness to pay more for earnings, and multiples increased from 13 times at a low to 24 times, 24.1 times at a high. But the second phase of that has really come through, true economic growth, and earnings have grown from $139 earnings per share to $221, and that has helped markets move along. Well, the reliance upon multiple growth, as we mentioned from the Fed, it's less likely that multiples move higher. So we're going to be looking more at earnings. Well, our good friends at JP Morgan put together a fairly thoughtful chart here around decomposing earnings growth. And in 2021, we really saw the majority, 75% of EPS growth coming from margins. Now, from 2001 to 2020, that's about half. So as we think about peak, wage increases, price pressures, that is likely going to materially impact margin. And so it means two things to us. The ability to continue to beat and meet on expectations is falling. It's going to be harder to do, yet we're relying on it more. And so that potentially produces volatility. So again, when we think about all of these things cumulatively, where does it put our portfolios? Well, first is when we think about just aggregate volatility in general. The US tends to be a little bit less volatile than emerging markets, than other asset classes. So we'd be modestly increasing allocations there. We can talk about that in a moment. Maintaining exposure to emerging markets, nonetheless, we do think could be prudent, given some of our comments previously on where China is in its economic cycle and the fact that it makes up over a third of the emerging markets index. The third here would be consider that interest rate volatility, not only just the current interest rate risk that exists in portfolios, but how to potentially manage it or potentially take advantage of it even more so. The shifting sands of inflation and making sure that we're having broad allocations to real assets and taking advantage of those opportunities and protecting portfolio from kind of decay over time. And then lastly, just from some of the volatility and timing elements that we mentioned, being patient and staying diversified, those are key, we would say, even more today than it has been in the past, as a success variable going forward. So Bob, I'll turn it back over to you.
Yeah, thanks so much, Brad. That provides a great overview. And as I mentioned earlier, encouraging participants to use the chat. And Brad, there's actually a good question in the first question in the chat sort of dovetails your question or your points about volatility. And it is, if an individual has a sizable amount of cash, what is the best way to invest it into the market, all at once or periodic basis? The firm's views on that.
Yeah, it's a great question. Timing is difficult. We don't see really anyone successful at timing. We would suggest a pragmatic approach to thoughtfully putting that in over a series of time. Now, yes, you could put it in today and markets could go and you could lose, but basically you're reducing the likelihood of, I put it all in today and markets crash tomorrow. I put it, all in next week and markets go up this week. If you thoughtfully do that over time, we think it reduces that risk, but you have to stick to that schedule. So find that schedule, commit to it now, and then, put that to work over, a decent period of time. We would recommend usually at least a quarter, if not 6 months.
Excellent, thanks. And I think this next question is a good one for Matt to follow up on. And it is with respect to, will the lack of vaccination negatively impact emerging markets? Likewise, a strong dollar, Matt.
Yeah, that's a difficult question. I think when we look at vaccination progress globally, anything that leads to slowdown in economic recovery in a local area is going to negatively impact that particular region. So, but at the same point, the United States isn't immune to that as well. So, but if you do have an overseas economy that's having a greater virus than they need to have because of slow vaccinations, you're going to need those central banks wherever they're at to potentially pause on the increase a little bit more. Likewise, in the U.S., if vaccination progress continues and the Fed can continue to tighten faster, that is probably what is most likely to lead to a stronger U.S. dollar.
Thank you. And then one more here on China, and there's so much out on China of late, but here with their heavy influence on the weight in emerging markets, various headline risks, is there any consideration for having emerging market equity exposure ex-China?
Yeah, I mean, I'll take that. China is obviously, it's a material part of emerging markets, the emerging market indice. As we mentioned, China actually has a fairly unique position amongst many countries, not just emerging countries, in the fact that they have a big war chest in which they can put to work. Their valuations are far more compelling as they had a tough year in the markets last year. So you can, China actually could be a leader in emerging markets. It's hard to say that, any year over year period, but there is opportunity there. If you're thinking about carving out China or doing something differently with China, we would think you would really have to have a thoughtful rebalancing mechanism around that, because China is such an important part. But you end up with around 23 countries ex-China, the greatest of which would be actually Chinese-related countries. So we would say sticking with the index, kind of China and its benefits, and all the underlying securities that it could potentially offer for an active manager would probably be a very prudent approach.
Excellent. And what I'm going to do, Brad, maybe just flash the last slide here, and then we'll take that down. But we're at about the 30-minute mark here. We promised we would keep things tight, which simply suggests that anybody with wants to access more resources and so on, please access our website, Insights section in particular, where we've got plenty of research, white papers, and so on. And if you want to kill the screen, Brad, here, for folks who need to run, we understand, but there are still a number of questions in the chat. So we'll continue on for a moment here and thank everyone for attending. Want to continue here with a question with respect to the next 5 years or so. When you think about the forecast, they have a question regarding the influence of inflation. How do demographics, healthcare costs, entitlement expenses, debt come into play? And that's a mouthful. Matt, perhaps you want to take a run at that?
Yeah, I mean, that's a challenge. I think, inflation is a part of all of those as well. So when you look at healthcare costs, entitlement expenses, those are essentially what we're talking about over the long term is deficit spending, which over time is likely to lead to inflation at some point. So but from a demographics perspective, we are also slowing from economic growth. That's another potentially over time. I'm sorry, slowing from a population growth perspective, which is also another thing that over time is going to slow growth. So all of those things, when you look out over the next 20, 30, 40, 50 year time frame, are all going to be very, very important. In part, that's why we focus more on the 10-year period, where yes, 10 years is hard enough. But that's where we're focusing, where some of those things those are all going to be issues over the next 10 years. We're gonna leave it really at the 10-year and not look beyond that.
Thank you. And then Brad, this next one on fixed income with rising rates. You mentioned this in your kind of in passing in your portion, but with rising rates, how would you handle the fixed income portion of the portfolio?
Yeah, I mean, I think at the very least, some investors might be surprised by the amount of interest rate volatility that's snuck into their portfolio. Even just the Bloomberg Barclays, the Bloomberg aggregate, still getting used to that name change, has increased its interest rate volatility materially. It's just under 7 years today. So there's a couple of ways you can manage that. One, you can incorporate other assets, which we would consider kind of non-core assets like high yield, or if you're a taxable investor, like muni high yield, global bonds, et cetera. For us, on a kind of year-over-year basis, we do think that the case for unconstrained fixed income, as Matt Rice mentioned, almost more of a strategy than an asset class, because it's an amalgamation of a lot of different resources, is a way to potentially take advantage of greater interest rate volatility. Because if you're simply systematically owning fixed income and you're just accepting interest rate volatility, you might, in a rising interest rate environment, just kind of have that as a headwind. If you're an active investor that has greater flexibility, you could use that headwind and actually turn it into your advantage. So there's a couple of different ways that you can bring that into your portfolio. The precise way to do it probably depends on your total objective. But we would say those are two probably pretty pragmatic ways for most investors to address it.
Excellent. Well, with that, I want to sincerely thank you, Brad, and thank Matt Rice as well, Kristen and others who helped pull this together. Again, on behalf of the entire organization, we are just so grateful for the confidence that our clients place in us and really the support that friends of the firm offer us. So please feel free to hit the website, reach out to any of the professionals, and we wish you a terrific and very safe and happy 2022. Thank you.